guys, and welcome back to another Money Tip Monday. I'm Lizzie Hofer, your host, and I am a residential mortgage loan officer here in the Phoenix area, teaching you practical money tips to help you make smart home purchases. Today on Money Tip, I want to be talking about what I think is probably the most tangible advice that you can have in money when it comes to a really uncertain and volatile market. So I'm going to be talking about the difference between timing the market, so investing or purchasing at the right time, versus time in the market. So meaning you are investing and purchasing and buying with a strategy over a long-term period of time, which I believe is the most sound way to make secure, well, the most secure financial investments. Now, before I get into all of that though, I am gonna need you to like, comment, and subscribe to this awesome channel so you don't miss any money tips in the future. So I started this video out by talking about an uncertain time in the market. And I just wanna say that I'm not an economist and I'm also not a psychic. I am somebody who's worked in real estate for a very long time, and I make it a point to study the market so that I can give my best advice when it comes to locking in your interest rate. Well, this is a market that I have never seen before, and it's really interesting because it's similar to a market that I've worked in with, right before the crash. But there are so many differences that I think that it's important to really talk about why sound financial strategies are so important. But I want to talk about why this is an uncertain market. So typically when it comes to explaining when people should lock in their interest rates, I explain that bonds are relatively similar to mortgage-backed securities and what they do and their inverse relationship to stocks, meaning that when stocks are high, typically bonds are low, and when bonds are high, typically stocks aren't doing so hot. So when I explain that to people, what I say is if stocks are doing really great, interest rates will be on the high side. If you hear that stocks aren't doing so great, interest rates will be on the low side, right? But we're in a market now where we've had record stock prices, right, because of earnings. And we're still in this weird global uncertainty, right, with the coronavirus and, deflation news in Europe, that bonds kind of become this safe haven, right, when people don't know what's going to happen with the global economy. So we have global purchases of our bonds, which are now keeping interest rates at historic lows. So it's such an interesting time now because we definitely have to study the economy in such an interesting way, but we are also seeing a housing crisis again, and not because of terrible mortgages, but just because there's just not enough supply to meet the demand. Many areas of the country, what we're seeing is that it's a seller's market. And so people are having multiple bids on homes, and it's just difficult to purchase right now. And so people are paying above asking price and above appraisal values. And so I've heard a lot of talk about, well, I'm just gonna wait this out and I'm just gonna buy when the market crashes and I'm just gonna, wait to invest. But here's the problem with that. Back in 2006, at the height of the market, interest rates were ranging anywhere between 5.6% to 6.8% on average. I had to look that up, so you can Google it too. But so interest rates were fairly high back then in comparison to where they are now. And so you had record values with high interest rates, and we had an unstable banking system, meaning that we loaned people out without paying down principal. It was interest only, negative amortization. It was short-term ARMs based on, the economy always increasing. I mean, it was just a terrible plan, right? Which is why it had such a catastrophic impact on the economy. We're in a completely different time where banking has still relatively been conservative. There are not mortgage products out there, or very few mortgage products out there that are risky like they were back in the early 2000s. Right. And so I feel like the banking industry is still sound, and we're now historically low interest rates, and we have increasing home values. Right. So people would say, hey, it makes sense to wait for prices to come down, but it actually doesn't. And I'm going to tell you what the economics behind that look like. And not because I'm a loan officer who just wants you to just buy a home now at the height of the market, but just because I think it's so important for you to know what the actual impact is on a mortgage, right, at different interest rates, okay? So at a $200,000 loan at 4%, right, which is higher than where historical lows are. So I just wanted to do just, general figures. A principal and interest payment on a 30-year note will be $954.83. Now, similarly, a $180,000 loan at 5%, right, will be $966. So that's literally a 10% reduction in value, still has a higher mortgage payment. And so then I was like, well, what if I took an even steeper drop, right? How can I get this payment lower, right? $150,000 at 5% would be $805.23. Now that's $150 lower than the original one, but you've lost $50,000 in purchasing power. So that would mean that the real estate market would have to dramatically decrease, right, for you to be able to purchase a house at that, right? So we're talking about another recession like we had, back in the Great Recession. How likely that is to happen, I don't know. Again, I'm not a psychic, but I'm telling you that even if we had a 10% reduction, which is unlikely now, it still makes sense to purchase when interest rates are lower. And I'm just talking about a 1% difference, right? This math increases dramatically as interest rates go up. Now, let's say we stop talking about mortgages here too, and we take this to the stock market. A lot of times people use that same logic when it comes to investing in stocks, in their 401k and IRAs. They're like, oh, I'm not even gonna do that until the market crashes. Well, the problem is, like, you don't spend enough time studying the economy to know when that's gonna happen, or people's earnings and their profits and their projections and all that stuff. That's literal people's day jobs, and even they're not good at it. My best advice is doing what's called dollar cost averaging. So it means that you would spend the same exact amount of money, right? And you would invest that same amount of money over the same amount of time. So like, for instance, $100 every single paycheck, right, would go towards it. Now, that $100 will purchase more and less depending on the value of what the investment is. But over time, right, you will have a consistently larger growing portfolio, and you will have bought in high times and low times. And this is Warren Buffett's strategy, guys. And he happens to be the most successful human I can think of, right? Who has like not invented anything or sold like this major invention, right? I mean, he is so beyond successful because he's a disciplined investor, and this is his strategy. So for me, I'm going to do something that is consistent, because I do believe that long-term investing, purchasing when you are ready to make an investment, and having like not intending to purchase with, large capital gains in expectations is the best way to do it, right? A mortgage is a 30-year investment, maybe a 15-year investment, right? Depending on your loan or how long you plan on living there, right? A stock, again, is a long-term investment strategy. I made this video just to show you a couple of the different principles behind the economics of investing disciplinedly, right? Versus just being emotional, deciding that you're gonna time the market, deciding that you're gonna go with what the news says, right, is the best time to purchase, and really just being disciplined over a long period of time and being consistent. I hope that this was it was kind of a long explanation, but that it gives you the baseline to do your own research on investment strategies, on purchase strategies that make the most sense for your family, so long as they're disciplined and consistent and thought out for a long period of time. Let me know what questions you have below. I'd love to start a dialogue. I'd love to hear your thoughts and opinions in the comments below, and we can maybe talk about some additional money tips in the future, right? So definitely stay tuned. Definitely subscribe to our podcast, because I definitely break this stuff down in more detail. You can sign up by texting Lizy, L-I-Z-Y, to 21,000. That'll be in the show notes below. And I will see you next week on another Money Tip Monday.